Hi everyone, welcome to episode 11 of The Aspiring STEM Geek. In this episode, I talk with Matthew Taylor. Matt has over 2 decades of experience in the financial industry and has worked with everything from public stock investments to private equity and debt investments. In the episode, we talk about how Matt became interested in finance and economics, how he worked with utilities early on in his career, the economics of natural gas, the current economic climate, how to deal with volatility, private equity, hedge funds, and much more. This episode is just for informational purposes and is not meant for investment or legal advice. Thanks everyone, and I hope you enjoy. Matthew Taylor, thank you for coming on.
My pleasure.
Yeah, I'm excited. This is my only second live recording, and this is the first time I've worn a suit. So,
we'll appreciate dressing up for us. You don't need to, though.
Back in the financial realm, I feel like I need to get dressed a little bit. Just to kind of set the scene a little bit, Matt was my boss at one point, so I'm really excited to have this conversation. And Matt was also a great boss, so I'm multiple reasons why I'm excited for this.
Appreciate that. And and welcome back.
Thank you. All right. Like always, let's start from the beginning, primary school. So you grew up in Massachusetts. Whenever I think about Massachusetts, I think of the great schools, Harvard, Boston University, MIT. Did you have this type of collegiate environment growing up?
Yeah, so actually the reason I was there, my father was an academic. He was a professor early in his career and worked at different universities.
What universities?
So he first teaching university was at Cornell University. Then he did a stint in Europe, and then he came back to his favorite place, which was the University Without Students, aka Bell Labs. But while he was at Bell Labs, he also went to MIT a fair amount, and that's why we eventually ended up in the Boston area. And then he went into consulting. So I always had an experience. My grandfather had been an academic. My sister had been an academic. And so we had a lot of people in my family who always were oriented towards university and education.
Yeah, that's I'm starting, I guess, that trend right now with teaching. But yeah, academia, especially a place like MIT, there just had to have so many interesting things in the engineering field. But you mentioned that your father did economics.
Yeah, and a lot of that is, as you find out when you do research, you never quite know where the research is going to take you. And his field especially was econometrics, which had a lot of applications for things Bell Labs was interested in terms of applied economics around costing and pricing. And it's probably hard for most people listening to this, but we used to price telephone calls based on both how long they lasted and how far away they were.
I am a little older, or I guess old enough to remember long distance calling.
Yes. And so a lot of what Bell Labs did was find ways to optimize network efficiency by using pricing to help ration a limited commodity. Thanks to fiber optics, we have almost unlimited bandwidth, or relative unlimited bandwidth, particularly for voice calling. So that's been a moot question through technology.
Yeah, you hear that, Gen Z? You're spoiled.
Absolutely. And so the academic area there, I always find the academic environment a unique one in the business world. So much of the business world is about specializing in your very, very narrow niche. And obviously good people can break out and partner. But in academia, if you're at MIT, the people down the hall might be doing applied chemistry. They might be doing something with, engineering for space applications, all sorts of things. And those sparks of innovation are really fascinating. And, Bell Labs was sort of that original idea factory that you could never know what that spark of innovation where it would come from and how, but they knew if they put enough tinder together, those sparks would happen, and obviously worked effectively for them.
Yeah, I've always been interested. I need to read a book about either Bell Labs or Bell Labs and Xerox PARC and all the innovations, because academia, you can have a lot of breakouts, but there's additional pressure on you when you're working in an industrial place like Bell Labs that you also need to capitalize on it and actually generate revenues.
I think there's a fantastic book. I believe the title was The Idea Factory about Bell Labs. And what's great is what you just pointed out there. They had a singular mission to make communications cheaper, more reliable, and ubiquitous. And one of the interesting things they did when they started Bell Labs out, it was still in the era of, telegraph. So talk about very limited bandwidth. And I remember one of the earliest things they were innovating was the telephone pole. How can we build better poles that last longer, and sort of really applied work? And only as they grew larger, they have more theoretical people coming in. But even that theoretical physics, theoretical chemistry, stuff they were really trying to develop was always about getting communications better, cheaper, more reliable. And from those innovations, we got the undersea cable, we got satellite telecommunications, we got fiber optics, we got the transistor, on and on.
Yeah, just compounds. It's shoulders of giants, like the saying says.
Yeah.
All right. Well, so in primary school, were you interested in finance or economics? Given that your father did it, did that influence?
A little bit. I mean, was much more econometrics or statistical analysis.
Lots of math.
Lots of math, which, I enjoyed math, but enough to know that I didn't love math. And so I skirted around the edges of that. I always had interest in finance and I certainly picked up a lot of the stock market stuff that was going on. Boston's has a lot of academia. They also have a fair amount of finance. And Fidelity Investments was a local hometown story. I grew up when Peter Lynch was sort of the star stock picker of the Magellan Fund at Fidelity.
Yeah, well-known portfolio manager.
And in high school, I got a job there and actually worked at the again, for Gen Z, you used to not be able to print charts very easily. And I was at the chart room of Fidelity, where we actually had a custom blot printer that we would run every morning to add, S&P prices and things for the portfolio managers to see that right now you can just get on Google Finance for free.
Technology is amazing. Even incremental changes, it's to think about how much their mail rooms also don't exist. And everything's email or instant messenger or messaging apps.
Yeah. I picked up a lot of interest in from there and always thought I would be interested in, I didn't have the patience for academia and I don't want to say minutia because some of it's very valuable and the difference in, my sister's more in the oncology field where it is the minutia that makes the difference between, life and death potentially. So I didn't have the patience for some of that. I did like a little bit more of the faster moving area of business and, always thought I would kind of end up in that field.
Yeah. I mean, I can agree with you on the minutia, kind of going through a master's program and seeing PhD theses and people really stretching into what they're studying. And I don't really know how relevant this is, but we'll see what happens. Yeah. But I think that is one of the issues right now with PhDs.
The creation of knowledge and, the overproduction of less relevant knowledge. I think it's endemic in a lot of fields. And people used to say, well, the hard sciences were exempt from it. I'm not always sure. There's been excesses in a lot of fields. But yes, it is.
Yeah. I'm trying to remember, is it Eugene French or Eugene Fama? I apologize for getting his name mixed up, but he's at the University of Chicago. And he was saying he developed the famous Fama French model. It's a 3-factor model, I think. Yep. And he was saying he was able to write a PhD thesis. And now he was saying he feels bad for upcoming PhDs because so much has been discovered.
Yes. And in fact, that's, one of the beauty of just taking a look at economics as a field, how much innovation it was. We go back to Ricardo, we go back to, Adam Smith and all that. But really with the ability to process and analyze data on a much larger scale, sort of post-industrial revolution and then post-World War II, it really changed the field of economics. So we had a lot more applications you could test and apply and, what's old is new, and as now we're going to have to study tariffs again and what that impact is. No one studied those in 20 years, but 30 years. But we're coming back to that.
We'll definitely bring that up later. No, I mentioned this before on one of the podcasts, but I think there's just really bedrock economics that's very important. It's supply and demand, just understanding as a good becomes more scarce. If there's a demand for it or demand stays constant, the price is going to go up, things like that. And then also opportunity cost.
Yes.
Just people, I think it's easier to understand as you get older, but how valuable time is. And even if you get a free ticket to an event, there is a cost to it. The cost is your time. So I think the bedrocks of economics are worth everybody knowing because it's applicable in your everyday life.
Yeah. And it hits all the fields. I mean, that makes economics somewhat a hated field within academia because good economists have taken their study and analysis in behavioral finance, psychology, lots of other fields where sometimes people feel they don't belong. But part of that's because the simplicity and power of scarcity, marginal costs, marginal benefits are just fundamental to what economists do and are not embedded in the same manner in a lot of other fields, in a lot of other social science fields.
Yeah. All right. Well, so since we're talking about economics, you eventually went to Swarthmore University, which is in Pennsylvania. Fantastic school, but kind of going back to the earlier question, given the university ecosystem in Massachusetts, why you choose to go to Swarthmore?
Yeah, I mean, I think Swarthmore is extremely highly regarded. At one point, it probably had the highest production per capita of PhDs. I was, while I didn't think I was necessarily going into academia, I definitely loved ideas and loved being around people who liked ideas. I liked the small liberal arts colleges, and back in my day, Swarthmore was not as preppy as perhaps some of the other New England small liberal arts colleges were. So, I kind of was going into a little bit of a different beat. The economics department there was extremely highly regarded for a small liberal arts college. Their professors in the econ department were editors of major journals and had a strong reputation. So it was a great place to be. And at a small college, you get to know these professors quite intimately. So that was good. And Swarthmore at the time was 1,400 students, so a very small environment, which was fantastic. And being in Philadelphia was great. I found Philadelphia and Boston to have a lot of similarities. The biggest difference is Philadelphia is much bigger and was really the heartbeat of the American Industrial Revolution in a way that Boston never was. Boston always had academia, had global trade, shipping, in a way that Philly maybe didn't, but Philly had the iron industry, the coal, the oil, and sort of all the things that drove modern economic development and, created a lot of wealth for people here in the economy and globally.
Yeah. Upside downside of that is as we've moved more away from, this is a hot topic in this year of, a month of April 2025. It's the big debate about industry coming back, but it probably peaks around the 40s, 50s, end of World War II. We don't have as much shipbuilding. We have the Philly shipyard here that's well known by people, but then you kind of have the bloat that's left over afterwards as we move from manufacturing to services. So it's just interesting. I guess I know the history of Philly a little better since I was born here, but I kind of want to learn more about the other states that were actually able to adapt a bit better. New York's always kind of had financial center, but Philly just hasn't been able to keep up in terms of its relevance relative to some of the other cities. And I guess if you look at Pennsylvania as a state, there's also issues there.
Yeah. No, and some people always say Pennsylvania peaked in the 1800s when we were larger than New York, and then we never got that back. But it's, in some ways, the Pennsylvania oil boom was the first real oil boom. We've been refining oil in the city since 1860 something. But better, faster, other places developed that had better resource endowments. I'd sort of phrase in the economist terms. And we never for a variety of reasons, never got the global dynamicism that New York had for finance. And but it's still a great place to live, and I've enjoyed being here.
Lots of, I guess, relatively speaking, for the United States, lots of history. Maybe not as much history compared to parts of Asia, the Middle East, or Europe.
Yeah. Now, 250th anniversary, so we'll have
coming
some
up soon.
celebrations.
Yeah. Okay, so going through Swarthmore, we kind of talked about economics. So you eventually declared your major in economics, assuming your father was a big part of that. So we could, I guess, go through to your early career. So after you finished your undergraduate degree, you worked as a consultant at Prudential Investments in the 1990s. I assume that was over in New Jersey?
Yeah, so actually, there was two separate jobs. I worked in the consulting industry as my first job. That was actually electric utility consulting. And I have to tell you, again, I was graduated in 94. The internet was not as big a deal at all there. And I remember they did a recruiting poster, and it was this was a utility consulting firm I worked for. In the mid 90s, there was massive deregulation happening in the utility industry. And I kind of played a good job interviewing, sort of looking at my dad's experience on telecom and applying it to electric utilities.
So the electrical utilities, because I was going to ask if utilities also included AT&T.
Yeah, no, it was really narrow. It was an interesting experience working with just electric utilities, but it was global. So the poster they had was of a utility project in Australia. And I said, hey, I'd never been to Australia. That sounds like a great thing. And so I went into consulting for 3 years and learned a heck of a lot about how the utilities operate. Very interesting model, the economies of scale that drove that. And similar to Bell Labs, a lot of innovation that had to occur to electrify economies around the world. And this company I worked for had a specialty in really nitty-gritty operational efficiencies. And so we would do benchmarking studies of utilities in Europe, Asia, the US, and bring these people together at conferences to try to share best practices.
Who did the best? Which continent?
What's funny is attitudes towards risk were some of the biggest ones that I kind of learned about. And, in Australia, there's sort of an attitude of, I love Australia. It's a great place to live, very relaxed culture towards lots of things. And unfortunately that included health and safety and following procedures and, but they were all really good people. It's a lot of that comes down to incentives and regulations and what the world was trying to figure out, and the industrial organization was, how can we make this utility industry more efficient? And Australia, New Zealand went very much in competitive deregulation and tried to make a market that, frankly, was the definition of a natural monopoly competitive.
Okay.
The US kind of is a hybrid model. I don't know anyone who enjoys picking their electric supplier.
Yeah.
And, typically the model that's now emerged globally, and I won't claim to be an expert, but what I've seen happen is you can get people to switch their electric provider, and then you jack up the prices, 12 months and a day after they sign the initial price contract. And most people are too lazy to change their electric utility price supplier every 12 months.
Yeah, that makes sense. Same thing for, I guess, similar to banking. If you think about it on a retail level, how hard it is to, maybe it is relatively easier to switch electrical services, but I know for me, for banking, I've been meaning to switch my bank, given how much I move around, something that has a larger footprint, but everything is tied to it.
Yes. No, the switching costs, that's that everyone loves to raise the switching costs or make it, really easy to stay. And so ultimately, electricity is electricity. You don't feel better if you're, maybe you buy green energy and feel better when your lights turn on with whatever that means. But by and large, people don't think of it the same way they think of other products and services. So I personally think the idea of the competitive nature of that market is much more limited.
Yeah, that makes sense. So after consulting, you went back into the financial world.
Yeah.
What was it like investing, and when the geopolitics was relatively calm? This is, every period has its own issues. I could think of the 1990s, Kosovo, Rwanda, those being issues, but we're talking in 2025, things are at least it, for a lot of people, seem a little bit more chaotic, relatively speaking, to the 90s. But did it feel that way, or?
It absolutely did not. And I think that's a good, an important thing to recognize, that while you're in real time, things feel more urgent, feel more, you've never experienced it before. But then if you look back over a 30-year period, I'll say like the 98 Russian default crisis and the Asian currency crises of the late 90s, that felt pretty bad. And I remember when I was applying to business school coming out of Prudential, someone said, don't go into emerging markets because they blow up every 7 years. And at that time, for the prior 28 years, it had blown up every 7 years at some regular basis. And, and we'd had complete global sovereign debt defaults, which we really haven't had to the same degree post that 98. That was sort of, the IMF changed policies, global economic trends changed. We've still had one-off issues with Argentina, with some other individual countries, but we don't see that wholesale, financial instability coming in that way. We've had other things happen, and we can get into that in a little bit. But it's it definitely felt bad at the time. I still remember at Prudential when the Russian debt default happened, and that was my learning on how this industry can sort of work sometimes. Where hey, what's our exposure to Russian defaulted debt? Well, the day after they defaulted, it was pretty small. The day before, not so much. But the finance world is always looking ahead, not looking backwards.
Yeah. I'm trying to think what else in the 90s. I know the Russian default. There was a famous hedge fund, long-term capital management, that blew up because of that. That was a risk thing that I had to read when I was going for the financial risk manager exams. They were I think they were heavily leveraged, meaning they took on a lot of debt to place wagers on Russian bonds, and that did not work out well.
No. And that was, for countries that today we think of as so developed and advanced, but if you look at what happened to the Korean currency, an utter blow up in the currency. And I had friends who were buying real assets in Korea at, more than half off the price. And, now 25 years later, Korea's effectively a developed country, positive, financial flows and everything else. And yet at the time it looked like, oh my gosh, this was going to be unrecoverable for decades. Yeah. And obviously the Asian tigers did not have a lost decade to the same extent that, maybe Argentina had or struggled with post their default.
Japan, by some counts, second, third largest economy in the world. It's kind of, it went, maybe that was but I think that was actually pre the currency crisis, though, right?
Yeah. Japan had the lost couple decades now at this point. I think the Nikkei peaked early 91, 92. And we can talk about some of those reasons, but the asset price appreciation with a very export heavily oriented economy. I still remember going to Tokyo. I was there probably 97, 98, and just being told by the person that, within a quarter mile of my spot, the real estate value exceeds that of California. And, nominal prices have, maybe stayed the same, maybe gone down a little bit, but the yen has gone way down in value.
Yeah.
And that's where you always have to have humility when you make long-term projections. Our local school district here in Pennsylvania in 1990 something decided that Japanese would be the next language for their school district to offer. We offered that now for 20 years, and now we're about to switch that to Chinese. So
that's actually, since I guess you hear, I wasn't in the industry in the 90s, but you hear about people that were talking about, hey, I remember when we were having this conversation about Japan, but now it's China.
Yes.
Yeah. So it's very interesting. Although the scale of China, I think that's probably one of the most significant factors, if not the most significant factor. And just the amount of trade. If you look at who China's trading with, they're the number one trade partner for so many countries.
Yeah.
It's just fascinating.
No, it is. And that's been an interesting rise because you had issues in China politically in the late, sort of post-Cold War. That fall of the Berlin Wall had ramifications that echoed throughout the Eastern Hemisphere, Western Hemisphere, and in China as well. and they took a different economic path than they had been in the 80s, and then just were on a tear.
Yeah, hopefully a lot going on right now, but Shanghai and Shenzhen, two places I really want to see. I don't know if you've heard about BYD. The batteries that they're making are superb and very innovative. And I know I haven't looked into it too much, but apparently the charging time is as low for some of their electrical vehicles as little as 5 minutes.
Yeah. No, it is interesting, and China has some of the most competitive markets in the world. I think that's what also has impressed me. It's brutal there. They have high pressures for pricing and consumer innovation, consumer delivery. That makes it a very, very interesting market to innovate in.
Yeah, I guess something I found interesting reading more and more about China is, yes, there's a centralized government, but each of the localities within China will stand up their own regional champion. And for example, in electric vehicles, a lot of these will compete against each other.
Yeah.
And you'll have competition within the country rather than globally, because there are subsidies that in that way kind of obscure the market, but there at least is some sort of internal competition where companies can rise and fall based on how well that they could do.
Yeah. No, and then that's always the debate today about industrial policy. Can you have, the size to create a national champion has grown, and frankly, it's grown beyond the size of nation states. As I think we're seeing, the automobile industry is a perfect example. Maybe the U.S. can support 3, but can Italy support 2? Can Germany support 3? Can the UK can't support any apparently, and France is So that those minimum economies of scale have gone up in size, and that's going to lead to a lot of transition, a lot of change, and where the innovation occurs. And I think that's where Mercedes and Volkswagen have been struggling. That engine technology is not the barrier of performance these days. It's software. It's other consumer products, electronics in the vehicles that historically Germany wasn't strong in.
Yeah. Just to briefly talk about Tesla, yes, they make cars, but I think the value that a lot of investors see is in their software. Mm-hmm. So kind of Tesla, and there's also Waymo, which is Google's arm that does the self-driving cars. It's not the cars themselves, like you're saying. It's the data, the algorithms that they have that can actually get that car to drive by itself.
Yeah.
Well, there's different levels in autonomy, and we're not close to it yet. There's still a lot of work to be done, but at least they're leaders.
Yeah, they're leaders, and it's gotten a lot better. I think that's something, if we look back at this 10 years from now, I'm sure we're going to sit there saying, hey, we just didn't know how close we were to having some things that look like breakthroughs. And, that idea that what we take for granted today, people 50 or 100 years ago would have viewed as magic is a truism in some ways.
Yeah. Not that far ago, ChatGPT came out, I think 2022, 23, somewhere around there. And that changed a lot of people's minds.
Yeah.
But okay, so going through the stability, instability of the 90s, you eventually went to work for Miller, Anderson, Sherrod, and I believe they had their offices here.
Yep.
And that was acquired by Morgan Stanley. This was also when technology stocks crashed in price. So a lot of people call this the tech bubble that blew up in the early 2000s, 2000, 2001. Mm-hmm. What was it like you mentioned the Russian default, but I'm guessing that this was a bit different and going through that. What was it like to go through your first equity market crash?
So it was actually ironically very good. I historically had been a value equity investor, and there's a lot of academic research that had supported the outperformance of value stocks, which means...
Could you explain value investing versus, I guess, tech investing, or maybe, what do they call it nowadays? The momentum investing?
Yes, yeah. No, the idea was, and there was a lot of academic literature around, a vaguely behavioral finance, that people over extrapolated good news and paid up too much for companies that things were going well at. And they undervalued what companies that everyone knew were not doing well, and that you could add value over a benchmark over time by buying stocks that are unloved or underappreciated and sell them when they got to a fairer value. That has been a very challenging environment for all of my career to be a value investor. But I've had a few shining moments. And the second half of 2001, all of 2002, and most of 2003, value absolutely crushed the tech stock parts of the index. And for a brief moment, we looked really smart. We had a lot of alpha, and we had, good experience.
Yeah, I think if you go to your Google Finance or Yahoo Finance, wherever you go, you look at the Microsoft and the peak that it had in 2001. If you invested near the peak, and I don't know when they put in dividends, I don't know about the total return, but the price return, it didn't catch up to that price till I think about 2017, 2018. That's a very long time.
Yeah, no, and this industry is awful for torturing data because you pick the start date and end date and the story around it.
Fair.
So I do remember, there were people saying, the 10-year return of the S&P 500 is below that of T-bills, and it was for a few short periods of time in different periods. But that doesn't mean that you should only go in T-bills. And, people generally torture the numbers to get to the thesis they want. And with a large enough data set, you can find, enough anecdotes to support that.
Yeah, we're touching on something that we'll eventually get to. But yes, the storytelling in finance is dubious.
Yes.
So just be very aware if you're ever talking to somebody about finance and they have a locked in trade for you.
With the benefit of hindsight, all my trades were locked in. And the human beings are wired to hear stories, and in hindsight, those stories make perfect sense. Where we sit today, we don't know a lot of things, but I can probably make a good story in 6 months what I should have known right now.
Yep. So after the tech bubble burst, you moved on to become a portfolio manager at Chartwell Investment. Just to give a background on what a portfolio manager does, there are a variety of tasks besides just investment decisions. You're also figuring out how to manage the amount of cash that your accounts have, manage investors redeeming or selling out of your fund, and you're also probably managing analysts that work for you, helping you make investment decisions. Mm-hmm. What did you find to be the toughest aspects of being a portfolio manager? And I guess you currently are one, so.
Yeah, different types of names. So when I was doing this in business school just after, we were managing a portfolio of stocks against an index. So we were trying to beat the S&P 500 or the Russell 1000 value. And when you're doing that, in the public markets, it's a very narrow set. I could only own X number of stocks, and picking the weights for those to express what views we had that were different than the market. And that's the only way to generate any alpha or any differentiated return, is to do something other than what the benchmark weights are. One of the toughest things with this industry is you're wrong most of the time, or at least 50% of the time. And if you do things really well, you're an amazingly successful investor if you can get it right 55% of the time, and everything else below that becomes incrementally harder. So when your performance is good, you feel more confident. You feel like you're better at doing what you do. When your performance is poor, you feel like you're awful at what you're doing. Mm. And that almost reinforces all the behavioral finance rules that we try to take advantage of. But we're all humans. We do suffer from that. And for me, I would say, particularly as a value-biased investor, value has not worked a lot of my career. It's had a few 1, 2, 3-year windows where it's outperformed, but by and large, this has been a period of time in which technology stocks have outperformed. And I have to admit, as a value investor, they've outperformed partially because they've delivered earnings growth that's been unprecedented. The entire U.S. economy has shifted on how we, from producing goods to more service-oriented, more, the whole concept of social media didn't exist 20 years ago, but now we have companies that literally touch 30, 40, 50% of the human population from a single company based in Menlo Park, or whatever, California.
Yep.
That couldn't have ever happened for a chocolate company out of Switzerland or a Mondelez. Yeah. And so that's been kind of cool to see. Internet has sped up the pace of innovation and the adoption of new technologies, and that benefits new companies, growth companies, not old technology value companies.
So that's kind of the public investing side when you were in business school. What about managing people and kind of the more, not just investment aspects, but overall managing a business aspect?
Yeah. No, and actually it's funny, for the investment management industry in particular, we like to pride ourselves on telling companies, here's how you should manage your business. I would say we don't have a particularly strong track record of managing talent. And, a lot of the companies you can name them because they're the exceptions. And so Fidelity, T. Rowe Price, Vanguard, Wellington have survived. CapGuardian, I guess, would be the five. There's a heck of a lot of companies that rose and fall in that same time period in my career.
Survivor bias.
There's a big survivor bias. And but at the time, Janus was a massive growth company that did extremely well and then did extremely poorly. And, this industry is tough because when you're doing well, you're feeling confident, people want you, you can go to other places. And when you're doing poorly, people hate you, don't want you, and you feel like you should be joining a second career. So
yeah. I'm trying to, what was was it a hedge fund that blew up in the 08? Lehman Brothers. Lehman, yeah. That's who I was.
Well, Bear Stearns, Lehman.
Bear Stearns, yes.
And that's also an important thing to note. I always appreciate your ability to look at things from different perspectives. We talk about the global financial crisis in 2008, 2009, led by the U.S., subprime U.S. mortgage debt crisis. I was just in Singapore a few weeks ago, and it was amusing to see that there are a number of people who call that the Western financial crisis, that it was really a product of U.S. and U.K., Ireland, and other countries having these highly levered, undercapitalized financial institutions, which some of the Asian countries like to throw back at us because we called it the Asian financial crisis in '98 when it wasn't really that. But it is a perspective. Where you sit affects that view.
Yeah, the perspective part is that's actually, I was going to bring that up later too, but kind of. We are very, very entangled globally nowadays in the 21st century, but there is still some value in seeing different perspectives and understanding how different countries or continents do things. There's still variation. It's not all uniform.
Absolutely. And I think I encourage everyone to study more on how the global economy, you see what the power of trade was historically. The Silk Road from the early, first century to, Roman era to today, a lot of those things still echo over time. And, one of the most fascinating things I sort of see in Southeast Asia is the Chinese diaspora that sort of emigrated from Shanghai, that port city, and developed these ports all along the Malaysian, Indonesian peninsula and sort of globally, their ability to trade and expand trade routes, and it really was an innovation. Something I heard from someone, which was an interesting approach, was you compare how merchant employees were paid in Europe versus China. In Europe, you worked for a shipping company, you might get a share of the profits, but it was through the shipping company and, you'd share as a ship together. Whereas in China, for a lot of their people shipping products out of Shanghai, you were given space, you were given weight on the ship. And a lot of those employees were early entrepreneurs trying to figure out, do I take, placeware of China and trade that for spices in somewhere in the middle, Indonesia, and what's the best way to make money?
Different incentive structure.
Incentive structures.
That's really interesting.
Yeah.
Yeah. I will say I've been able to travel to 4 countries in Southeast Asia, and I really, really enjoyed Vietnam and was right off the bat impressed. I flew into Hanoi and we got a Grab, which is their version of Uber. Yep. And the vehicle that they had, I think it was a VIN, and that is the locally produced electric vehicle for Vietnam. And it seemed like a Tesla. It was a beautiful car. It had a huge monitor in the front. And it actually, I'm not sure if Tesla has this. It's actually been a while since I've been in a Tesla, but it had a overhead view of the car itself. And I was just very, very impressed by some of the technology I saw there.
Yeah. No, I think, what's happened in Southeast Asia is just absolutely phenomenal. And, a lot of different paths. And unfortunately, sort of the post-colonial period of the post-World War II era, was very destructive for Vietnam. Different paths for Malaysia and Indonesia, and then Singapore was sort of the gem of the area that survived a lot of that and really thrived in that global trade route.
Yeah, it's just very impressive. All right, well, okay, so we talked about portfolio management. So we're going to fast forward a little bit. So like I said at the beginning, you were my boss. I came into a firm that was called Permit Capital Advisors around 2017 and worked as an associate for you. You were, again, a portfolio manager. Mm-hmm. Without going into specifics, I want to talk about some of the investments that the firm oversaw. Mm-hmm. It was my first exposure to private equity, private debt, hedge funds. Can you explain what hedge funds and private equity firms are for the uninitiated?
Sure. And a lot of what we talk about is public versus private. It's a common term. Public are public securities that are listed on exchanges that you can go to Yahoo Finance, Google Finance, and see how they're trading every day. The vast acceptance of indexes and index funds mean that you can see when people say, what's the U.S. market done this year to date, this month, the last 5 years, you're generally talking about the S&P 500 or Russell 3000. You can get a sense of what every publicly listed index has done in aggregate for a period of time. There's a whole other market that's the private market, and those are companies and investments that aren't listed. And there's a variety of reasons why companies don't get listed. They tend to skew smaller. Obviously, every company that started, a venture capital-backed company, starts as a private company, an idea in someone's garage, and then they grow it, get financing, and historically had viewed starting a business, financing it, and going public at some point. That's now being delayed a bit. You can, SpaceX is worth hundreds of billions of dollars and has not gone public. But by and large, when we think of private investments, we're thinking of smaller, less liquid, less well-known, nichier type investments. And for us at that firm, we were looking at providing for clients, for larger people, as you get larger in your asset size, diversification is important. And I think that's something always hammered in, that you have to have a diversified approach to investing because, well, certainly if you have assets you never want to lose, you never want to be out of the game. I would actually go back to my days at Prudential, where one of the nice skills I learned there was, as a life insurance company, their overwhelming mandate was to never not be able to pay a claim. And so all the investments they did were always through the lens of how does that impact our ability to potentially pay a claim? And you have, triple redundancy, 9 zeros type.
Have to
within
match your assets and liabilities.
Correct. And so for the private client side of this, if you have clients who have very large portfolios, they want to diversify as well and make sure they're not just exposed to public and private, but are buying other asset classes that have correlations that are very different than the public markets.
Yeah. Yeah, and when it comes to some of these private investments, it might be a little easier to understand when it comes to debt. There's a additional risk premium that you have to pay out usually. Do you think that there was an issue with when we were in that period somewhere between post-financial crisis 2012, even 2010 to 2019, that interest rates were so low that maybe people weren't getting as compensated on the private side for things like debt or maybe even equity too?
Yeah, no, absolutely. And if I look at big trends, we talked about globalization and technology change. Another big one was the rise of debt leverage. And if you look at how much debt the U.S. economy, both government, corporate, and consumer debt, we've been on a massive leveraging. Now, a lot of that's related to interest rates coming down, but I would say also some of that's coming down for people's comfort with holding higher levels of risk. And for private equity in particular, you used to do leverage buyouts at certain debt levels. Those expanded massively in the post financial crisis, as rates came down, companies suddenly could borrow 4, 5, 6, 7 times their net income in debt, and investors were willing to lend them that money. And as you know, leverage amplifies returns, and as long as things are going well, you'd much rather be a leveraged equity investor than not. And that's why this rate cycle we had most recently kind of caught people off guard, and we're not through the end of it. We're not seeing the exits from the private markets. People have had to adjust for higher interest rate costs and higher managing down their leverage ratios, and that's going to take some time to, if I had to pick emerging themes, that's going to be one that's going to play out over a period of time.
Hopefully not as disruptive as 08, 09, but we'll see. I don't know. I guess I'd be surprised if that happened, but definitely something to keep an eye on in terms of risks and worry.
Yeah, and you can see it as a consumer. If you look at private equity has found a model that's very sustainable and repeatable, which is, the term is rolling up an industry. And, for people, take a couple of veterinary services, used to be predominantly single practice, family-owned businesses, and private equity found that was a very stable, profitable business that they could buy, acquire. The veterinary doctor retires, you build a larger facility where you get economies of scale and
more vets.
And maybe you use that labor more efficiently. That's sort of the positive economic spin I could have. The other side is you can price them more aggressively, and we get rid of some competition in the market.
Yeah, that's really, I'm just imagining a 1980s corporate raider, Wall Street slick backed hair that's dealing in Fed.
We found more industries that have done that. So veterinary services rolled up, dental, we're still in the process.
I was going to say, because I think it was, Nassim Taleb, he wrote, he came up with the term, or at least popularized the term Black Swan. Mm-hmm. He always referred to the stability of income of people that work in the dental field.
Yes, and what you find, though, is private equity, they get attracted to that because they can put a high level of debt on it. And then the sort of secret sauce or magic that a private equity manager brings to that is, how can we take a business that was growing revenue in line with consumer incomes and do something different? And that's why, depending which dentist you may go to, you'll be pitched a lot more cosmetic services these days than you would have been pitched 20 years ago. And depending what state you're in, the dentists can do Botox, they can do teeth whitening, teeth straightening. And those are very high margin products, very high margin services. People are willing to spend a lot more money on themselves potentially for beauty than insurance companies are. Certainly. And so that's how this industry, from the private equity standpoint, loves it, that they've taken an industry priced off of 3% revenue gross with XYZ margin. You can make revenues higher, and you've suddenly earned an excess return.
Thanks, Gordon Gekko.
Yes. And so, be aware of which other industries will roll up, and you'll know you're going to be paying more for probably less over time.
Okay. Really interesting. Okay. So one of the reasons to invest in a hedge fund is you have something like a private equity fund or private debt fund that's uncorrelated. Kind of, what are the benefits of diversifying your portfolio into these? Like, we talked about diversity, but can we delve into? We can even get a little technical if you want to.
Yeah, no, and again, you'd mentioned the magic term asset liability matching for an insurance company. It's fairly, there's whole actuarial science about matching assets and liabilities. But for most people, you are saving for retirement, for a college education, for different specific goals. And your risk, and defining risk technically, risk is the uncertainty of what your cash flows or asset value is going to be over a particular time or at a point in time. And so what we want is a portfolio that has diversification so that the risk is ideally muted, and we can minimize the variance of the returns or the size of the portfolio at a given period of time in the future, given all that uncertainty.
Yeah.
The hope is that these assets are not correlated, but as Nassim Taleb said, in crises,
everything's correlated.
Everything is correlated because ultimately there is, that is the nature of financial speculation and asset values. Some assets are much less volatile than others, though. And real estate, to your point about dentists, multifamily housing. People tend to pay their mortgage, their rent bills every month, and it takes a big shock for people not to pay that, and that goes through other fields where you can build a portfolio of cash flows and try to maximize the return while minimizing the risk of a shortfall that would be painful for an individual or an institution.
Yeah. So makes sense on the private equity side. On the venture capital side, I mean, it's a really interesting thing, and a lot of interesting companies and relevant companies have come out from venture capital. Facebook, you could think of a bunch of them, but very different strategy there, where it's more of a gamble, and you need a basket of companies to invest in. Although you expect a fairly high proportion of them to fail, and you have an outsized return for one of them. So there's so many different flavors of private investment.
Yeah, no, and venture is the highest risk. You're coming in early, and good ones expect more than half their investments to turn out to be a zero. And there's a bit of fads that come into that. There's recency bias. That you want your failures to fail quick and cheap, and reinvest in your winners because that's what's worked most recently. But maybe that won't work in the future. Who knows? I think where we do feel comfortable is innovation is going to continue, and I see the rise of venture capital as really providing a democratization for risk seeking. And, instead of it opens up more innovation globally, which is only a good thing for humanity.
Yeah. So, I read the news like everybody else, including the financial news. How often does the term AI come in when it comes to investing nowadays?
So the advantage of being older and being in the industry long enough is what I call it is the slide. Every single investment deck has whatever the hot thing du jour is for the slide. And earlier in my career, 08, 06, 07, 08, maybe even a little bit later, it was China. Every manager, every company had to slide about how we are growing in China, expanding in China, responding to China. And then it changed to peak oil. How are we exposed to commodity risk? What are we doing to adjust that? And those things have changed. DEI was in, DEI was out. Then we had, AI is now in. And I view a lot of that as obligatory checking the box. Hey, anything can be, if some employee is using ChatGPT to write their corporate emails, are we an AI enabled company? I think the hype is always based on, there's an alluring premise. There's always a nugget of truth that this is going to be really substantial. It's not going to be substantial for everyone. And you think of, again, not to pick on Nestle, but, ultimately making chocolate bars for, global consumers, it's not going to change that much with AI, I don't believe. Maybe really wrong. But
I agree with you. And then in terms of, I've said this before, but like the really three important things that we don't have to go into DeepSeek, but even with the development of DeepSeek on allegedly less sophisticated chips, there's really three things you need. You need very, very, very talented people that can develop the algorithms. You need compute, which is a lot of GPUs and very costly and energy intensive. And then finally, you need data. And I think people don't think about the data portion a lot. There's going to be, like you've been saying, economies of scale, meaning you need a really big company that could afford all these three things. And there's probably only going to be a handful of winners. And Google has really developed the technology behind this, or the algorithm behind this, the transformer. And they're probably going to be in the lead. OpenAI is going to be in the lead. There are probably going to be a few companies out of China, but it's not going to be a huge field that I could see.
Yeah. And I think that, you think of Google as for search engine optimization, for, product research, for other aspects where they touch the consumer. I think what'll end up happening is you think of financial services. How is a life insurance company going to use AI? The data sets are really important. And obviously for like a life insurance company, they have probably the best data set on a very narrow branch of actuarial science and actuary data. the question is Google can probably exploit that in some ways more efficiently. They can, always fascinated in how technology can work around constraints along data. So you think of Waze versus Google Maps, and do you actually have to map out the roads, or can you just map out how the phones move and just make an assumption about what the routes are? So I think, smart technologists will have ways to solve the data set question. I am intrigued if data is going to be more constrained going forward.
It definitely will be. I know, I can't remember who, but it might be both of them, the New York Times and Wall Street Journal. They have some sort of agreement with OpenAI on training their algorithms on their data, but that's another first mover advantage that OpenAI, Google Gemini, maybe Perplexity, maybe Mistral have, where they were sucking up the data before people knew how valuable that data was. And now people, to be fair, that is their data, and they probably deserve some sort of cut. I don't know how you work that out, but it's not going to be the same free ride that it was in the early years.
Yeah, and I think back to giving a specific example, Capital One, probably one of the most innovative consumer finance credit card companies. Back when I was doing public market equity investing, I remember in 2001, 2, 3, meeting with them, Richard Fairbanks, Nigel, the CEO, COO. They had data sets that were really phenomenal among a certain set of consumers. And they were, famous for running these tests on different things. And I remember the story they gave me is if they looked at people who rented apartments and then looked at their purchase history and found people who bought certain products that reflected high quality treatment of a rental property, you find out those are people who are generally very cautious about not paying their credit card bill. All sorts of data hacks they sort of got to find the holy grail for them was finding people who wanted to borrow money but also wanted to pay it back. And if you think of the credit card companies, the amount of payment data they have, huge opportunities for learning and pricing, and that volume of data that companies have and expect, and the pace of that, real-time pricing adjustments. Back in the 80s and even the 90s, we were still publishing pricing for airplane travel on paper documents. And now you think of how the airlines are using pricing algorithms to change, where you come in from a search perspective, where you're located, all of that stuff to try to maximize their pricing revenue model.
Yeah, I think kind of what you're alluding to is you can have something that's very generalizable, like a ChatGPT from OpenAI, but I think there's just still going to be a very big value in actually knowing the underlying dynamics of whatever industry you're in. Yes,
because and that's always the trade-off as you're earlier in your career. Is it industry expertise versus just raw horsepower and whatever the newest technology tools are? There's trade-offs because particularly in regulated industries, can get in trouble if you do things that run afoul of regulations. And some of those regulated industries in our economy are healthcare and financial services. But if you're in consumer products, you can, generally run pretty far as long as you don't touch some certain guardrails.
Yeah, that makes sense. So for kind of moving into a very important but always present industry, energy, I actually had somebody on that worked at Schlumberger as an engineer and got to hear his perspective about natural gas. But one of the investments that you oversaw was a liquefied natural gas facility, or LNG, in the Northeast in the United States. So to explain liquefied natural gas, it's an energy source, mostly methane and ethane, that is cooled to liquid form to more easily transport. LNG is also significantly more dense than natural gas in its gaseous state, meaning you can transport more of it in its liquefied form. And why is LNG a good option as an energy source for the Northeast of the United States, where it gets very cold in wintertime?
Yeah, and that's a factor of how energy consumption grows when temperatures get cold. People turn on their heaters and need that. This has been an interesting, talk about technology changing and having big evolutions. A few things have happened. In the U.S., our energy supply of natural gas through the innovation of fracking technologies has expanded the supply of inexpensive natural gas from Texas, Permian Basin, from Marcellus in the Pennsylvania and Permian in Texas. And that has dramatically shifted what the energy outlook is in the U.S. So when I was a kid growing up in New England, we had a lot of coal plants, we had a lot of nuclear plants, we had actually a relatively small number of natural gas, because natural gas was always expensive in the Northeast. We had some gas lines coming down from Canada, but ultimately we were at the end of the straw coming from Texas of where most of our oil and gas was in the U.S. Fracking kind of changed that and made it that nuclear and coal were no longer cost competitive, and there was other environmental and public policy reasons why those were not popular technologies. But natural gas has also a strange, there are people who don't like fossil fuels. So New York State has been a barrier to building pipelines from Pennsylvania, where we have too much natural gas in some ways. We're exporting it to outside the U.S. when we still have not enough gas supply in New England on those coldest days. And if you think of the reason, you can build a highway, to build a highway for peak demand at 5 p.m. on a Friday in the summer in Philadelphia, you'd have to have a 40-lane highway. And the problem is that costs way too much for the 4 peak days a year you'd use it. So we have smaller peak lines and we have capacity constraints. Well, in the heating world, when you have a constraint, when New England demands a lot more natural gas and it's not there, you do load shedding as utility. You stop generating electricity with natural gas. You make those generators switch over to fuel oil. You do other things to try to lower demand when gas gets expensive. We saw an opportunity to liquefy natural gas. As you mentioned, it makes it 600 times more dense as an energy storage system, and it's effectively a battery. We use electricity to make out natural gas really cold. We then truck it to storage tanks, and the utilities in New England have several dozen around the whole Boston metro area. And on the coldest days, Boston is running about 40% of its natural gas off of stored LNG.
That's a significant amount.
Yeah, Pennsylvania even with all the natural gas we have here, Philadelphia runs about 20% on really cold days. And you think about it, it's just because when it gets really, really cold, people are turning their furnaces on and are running full blast.
Yeah, demand spikes.
Yeah.
Need to heat it somehow.
And we've been not diversifying our energy source. So back in my utility days, the utility commissions used to really focus on energy diversity. That was a portfolio construction tool, no different than finance, that you wanted to have a mix of coal, nuclear, and natural gas to make sure you weren't overly exposed to one issue. That came out of the 70s, concerns about supply interruptions from our overseas energy. That went out the way when domestic natural gas became so prevalent that we were exporting it, for good or for ill, we are powering our country on natural gas right now.
Yeah, well, it's also when it comes to alternative energy sources, besides the clean energy for something like solar and wind, it's just not feasible in some places like the Northeast of the United States, where it's very cold, it can get very foggy, lots of rain. And you actually see it in places, it works in places where you might not think of, like Texas. I think Texas has the largest wind generation out of any other state within the country.
No, exactly. And energy is a great industry for a lot of data. You can analyze data, minute by minute, and it's fascinating for me for utilities. You think about it; they were building these electric grids in the 30s and 40s before we had any modern technology, and so they had something called SCADA, System Control and Data Acquisition. So imagine a day when we first were building those electric grids. That was pre-telephone. That was when everything was a telegraph. And the data collection that you needed at the central plant to really figure out where electricity was demanded, where faults were, all of that was really primitive from today. A lot of it still is in use because it's very reliable, but it's not very sophisticated. I think we'll have an energy revolution as we get better data and can analyze that better.
Yeah, very interesting. All right, so kind of moving from energy kind of back to real estate. So In terms of investing in private real estate, either commercial or residential purposes, what are the advantages compared to just a real estate investment trust, a REIT, which are far more liquid and you could buy with an online broker?
Sure. Yeah, and the REITs are very diversified, and it's really an innovation that you can just with a single click of a button get exposure to thousands of properties across the entire country or even globally. There are fees associated with that. There are costs. There's business leakage, and the prices you pay, are not necessarily as cheap. The allure of buying property directly is you can cut out the middleman or the middle corporation, as it might be, and absorb, give up the diversification and absorb some single asset risk, but in return for that, get 100% of the profits. So it's always a temptation to try to do that. Real estate's not for the faint of heart. If you look at asset classes that we talked about, it's one of the most leveraged asset classes out there. You can borrow a lot of money. There's a lot of reasons why, as a society, we want to encourage property building, residential construction building. And the problem with debt is if it's too cyclical, the downside, you might not survive as an equity holder.
Yeah, it's a very interesting time. I haven't looked recently, but during COVID and post-COVID, there's been a lot of vacancies in specifically commercial areas, and that affects not just the people that rent it or the owners of the real estate. It also affects the local economy. I haven't looked at it recently, but I'm assuming that vacancy rates may have recovered a bit, but they're definitely not pre-COVID levels, if I had to guess.
Absolutely. And that's the nature of work changing as well. And we've seen that here in Philadelphia, that a lot of some industries are more effective working from home, working remote than others. And for those industries that figured out that they can manage a workforce, manage their customers remotely, why spend money on a big expensive office building and having your employees commute if you don't need to? But from a public policy perspective, that's a real challenge. And you see that in Philadelphia where, the commuter, SEPTA, our regional rail system, has still not gotten back to pre-COVID levels. And I'll say for our largest private employer in Philadelphia, which is Comcast, you can see at the train station which days Comcast has its employees come in because the trains are full.
Yeah.
Other days they're not.
Yeah, it's funny. I actually know a few people that work for Comcast in kind of their white collar jobs, and they are remote.
Yes. Yeah. No, in certain industries it works extremely well. Law, professional services, it can work. At the same time, you see the pressure that from a public policy perspective, New York has been putting a lot of pressure on their private employers to come back to work. And the restaurant and ancillary businesses are critical for a lot of residents of those towns.
Yeah. Let's go back to rates for a second. So we talked about how the rate environment was relatively low. So you had the 10-year treasury somewhere between 2% and 3%, some between 2010 and 2019. Do you think that a lot of people talk about how that affected the what's known as alpha, which is returns over a benchmark? So it could be a portfolio's manager's returns over the S&P 500. Do you think that was really a consequential part of why hedge funds could, or even just managers in general, couldn't generate alpha? And do you think that there's going to be opportunity now that they have the volatility that they're claiming that they wanted?
Certainly for private equity, that was the big driver of excess returns in the 2010 to 2020, 21, 22 period, is the ability to, finance higher leverage with lower cost debt and get an absolute higher level. For public equities, it's not clear yet on that volatility. I tend to be fairly strong efficient market hypothesis that, truly repeatable, sustainable inefficiencies in the market don't survive. And I think what you do see from hedge funds that are successful, some of the largest millennial Citadel type managers, is they have an ability to act as a market maker to effectuate their own returns, to earn a spread and just leverage that massively.
So like a market maker, to explain, if you have an account at Schwab or TD Ameritrade, you want to buy a stock or sell a stock, then Citadel or Millennium or name your hedge fund can be there as an intermediary and buy or sell you that stock or that asset, I guess. Or So at least there's some, you're buying a stock or an asset, but where they can really take advantage of you if you do something like buy options, which is, I don't recommend most people try to buy options because that's not there's only one winner in that. Not everybody's going to benefit from an option.
Yeah, no, and but the great news is with all the innovation and globalization we've had in financial markets, it is pretty amazing that with one trade you can buy an index fund, a mutual fund that has 7, 8, 9,000 global companies all around the world at a spread that is a fraction of what it was even 10, 15, 20 years ago.
Yeah, that is a great thing, and regular, just that your average person being able to access that, because I mean, you go back far enough, they didn't price things in cents, so that was a big innovation in the 2000s, I think.
Yeah, no, exactly, and spreads narrowing. And it's something that's kind of counterintuitive, but you as a retail investor pay a lower spread than active managers. You want to talk about all the barriers for active managers, but if you own 5% or 10% of a company and are trying to sell the stock, you're going to have an influence on the price. Whereas if you're trading $100,000 or less of any retail, any stock out there, you're generally going to have no price impact, and you're paying a fraction of a penny to one of these market makers, and you're happy to pay that because it's it's irrelevant for you, but it adds up for some of the larger players.
Yeah, that friction that used to be such a maybe $5 commission even 5-7 years ago, that's gone. It's amazing.
Yeah. No, when I first started the industry, it was still percentages. I mean, it was still 3, 4, 5% to buy and sell stocks potentially. Which benefited value investors in buy and hold. Certainly if you had a high turnover strategy, you were paying a lot in commissions and spreads.
Yeah. All right. One of the last things I want to talk about in my time at Permit is GameStop. I've mentioned this before. So on the floor, actually this floor where we worked, investors from other firms that invested their own money or some of their clients' money on the market would gather and discuss investment ideas. One of them was GameStop. This is pre-2020 GameStop. This is GameStop in 2019, 2018.
Yeah.
And the investment thesis that someone had was this business is going to go away, but if you look at the current cash flows, so you can think of cash flows as profit over X amount of years before GameStop goes out of business, it is undervalued. So instead of trading around $4 or $5, it should be somewhere between $15 and $20. What happened compared to that investment thesis is just, so you had retail investors or people that are not professionals gathered on an internet forum, realized that the short interest or the amount of shares being shorted was more than half of the shares outstanding. These retail investors, they realized that if the price rose modestly, then there would be a short squeeze, meaning the short sellers would have to buy back the shares they shorted, which would raise the price even more. So if you pitch this idea to anybody, they would think you're out of your mind. But this is what eventually happened. And it's one of the things that solidified my decision to leave finance, because my thinking after the GameStop episode was there's way too many variables to be able to forecast the stock trajectory of a company. And this also solidified my decision to study statistics in graduate school because of entropy and complex systems. Yep. So I'm just curious to get your take on my assertion that there's too much randomness to value a company in the traditional way for most investors.
I think certainly for individual investors, I'd much more encourage people to go into a broad diversified index than to try to calculate that on their own.
Oh, yeah. I'll also put this disclaimer before the video, but none of this is financial advice.
Absolutely. But yeah, I think in the long term, and the long term can be very long, stocks will follow fundamentals of cash flow. I do believe that. Now, GameStop was an extreme example where, and I'd say long term, take a couple of years, and GameStop sort of evolved a bit. But yeah, during that crazy, 90-day, 180-day period, it was, being a meme stock was, a crazy period. I would also sort of highlight that period before, and it takes a lot. And that company had been on a very poor trajectory. And as you mentioned, the person who had that thesis certainly had a thesis that the company would have more profits, had more cash flow, had net cash on the balance sheet, could have done things to return more money to shareholders prior to this whole thing coming. It showed me how hard it is to change management's view. And to actually run a proxy fight is a very involved process. And, we don't talk about it as much, but one of the challenges of the rise of index funds is, the owners of the largest owners of almost every company in the S&P 500 are passive managers, which means they own the stock purely in its weight in the index. They make no particular claim about the value of the stock or anything.
So this will be your BlackRocks, your Vanguards.
Vanguard, Fidelity, State Street control, easily 30-40% of most of the S&P 500. And to get them to vote, they will generally vote with management. They hire proxy consultants to help them decide how to vote. But to get them to vote against management's a big decision, and it takes a lot of effort, and I would say sometimes some egregious behavior by the part of management or boards to vote that decision to change. And if you think about it, if I'm at a hedge fund and I own 20% of a company, I will get the economic benefits if I can change that. But when you're an index fund, you could care less whether the company's run well or not well to some extent, because you're still going to track the benchmark the way you were. And I think that's going to be is a little bit of an understudied area of the economy. I mean, we always had this debate that if everyone indexed, it would be a problem. Someone needs to be providing price discovery.
Yep.
Now, Jack Bogle would argue that it might only be 5 or 10 or 20% of the market could be enough to provide a very efficient price that can't be sustainably harvested. Because if it was, we'd have more people put money in until there wasn't.
Yep.
But at the same time, I do worry about corporate governance going away, that if there's nothing better than someone who truly has invested their personal money going to a management, to a board saying, you're not doing stuff with my money and I need you to change, that you just don't get with a big corporation.
Yeah. Now I kind of want to meet a proxy consultant. That sounds like a very cushy job.
It is, and it's a very legalistic approach because they have to have a process. There's 3,800 or so publicly listed companies in the U.S. They have to have something that cuts down the list of proxy decisions. So usually a company has to be on a naughty list to get more scrutiny, and that forces things to happen. But what you find is, like a lot of corporations and processes, it gets to a checklist, and it's easy to measure certain things. Well, do the directors own shares? Are they diverse? Are they this, that, or the other? And do check boxes. And corporations are very good at exploiting that to look good on some things. And I would remember the GameStop proxy fight. The company certainly put out a lot of marketing materials to sort of show that they were excellent on certain characteristics that I would say were irrelevant to the performance of the share price, but made them look good or look better for consultants.
Okay, interesting. All right. Well, let's get into this time period now. So we're in very interesting times. So there was past month, maybe just weeks, a announcement of tariffs, and then a lot of uncertainty about the tariffs. The market doesn't like uncertainty. Everything's been affected, from equity markets to bond markets. Now, a lot of people are talking about the bond markets, to currency markets. And the last two, not a lot of regular investors or regular people really look too much into the bond markets and dollar markets. So given all this volatility, is this a time to be in cash? Because that is one of the ones that cash is going to have that stability, at least, assuming the dollar doesn't collapse. Mm-hmm. But is it cash? Is it some type of other asset that but might be good to hold during a time of volatility like this? And still, we're in an uncertain period.
We certainly are in a period of uncertainty. And, I would say certainly when it comes to a specific asset, it comes back to what I mentioned earlier on asset liability. Why do you own a particular asset? Ideally, it's to make a profit to fund some future expense or need of yours. And, the option value of cash is quite large when the markets are volatile. Ideally, you can buy equities when they're down or sell them when they're up and deploy it in a safe asset. I would say for me, this is a good example of where the fundamental economic activity is going to translate into stock performance. The stocks can react instantly, whereas ships coming from China take, several weeks. They have to turn around. Do they get unloaded in a port? It's going to be a period of time to see where this all falls out. And I think where the markets react quicker and sometimes with more of an order of magnitude is because the fear of we don't know, and in uncertainty, we have to assume potentially the worst outcomes for people. The only thing I would say is it's really been unprecedented. We haven't done an experiment like this in a very long period of time. And I think a lot of people, from stock analysts to politicians, are going to be analyzing why was the economics industry pretty universally against tariffs going back a generation or two. And that's now, by this current administration, is being turned on its head. And we're going to see what those impacts of that are. And at the same time, the U.S. is running very substantial public deficits, trade deficits, and a very large capital surplus. Some of that's being driven by us being a reserve currency and being the haven of safe assets. But that might be called into question. And I think there's, you touched on, manufacturing changes in the U.S. Some of that was driven by the fact that we became a reserve currency. Our currency became overvalued relative to other countries. We couldn't support manufacturing and export in those areas.
Yeah, I'm very curious how this will look like 5 years from now, because we're still in the thick of it. But there's some manufacturing that you can bring here, but a lot of people in the financial economics field always point to automation. So you can, as a owner of a business, you can put more money into capital, which just means that you're putting money into buildings, robotics, and a lot of economists and financial people think that that's how it will turn out. So that means just more robots and a few workers. And issue with also some of these the industries that could be coming back, you probably need a high level engineering degree to work in some of these factories. And I've seen some of them, and they're very impressive, but usually there's somebody with a electrical engineering degree that is manning the machines there.
And it's fascinating to see which industries were hit that globalization competition first. And the automobile industry is actually a good barometer for that. And you've seen the minimum scale efficiency size of plants get larger and larger and larger. And the problem is, if they get larger than the size of the local market for automobiles, then you've priced yourself out. The economies of scale are too large, and you have China supplying the entire world's car supply. But it's, I've been to one U.S. automobile manufacturing plant, the Nissan plant down in Tennessee.
Okay.
I'd never been in a building that was a 1 mile long building, and literally from raw materials coming in the front of the door to a finished car out the back. It's pretty impressive. But even that is obsolete relative to the newest, latest technologies, and that is going to continue. And, and I think that's the other thing. If I talked about where we are today, industrial policy, and China's not made any secret about it. I mean, they've been looking at capitalizing in certain core industries where they can dominate, building better, cheaper products and drive these economies of scale so large that other competitors can't compete, whether that's solar cells, whether that's automobiles, electric vehicles, batteries, those types of things. And the fear is, obviously, they use that pricing power, force your competitors out of business, then raise pricing later. We have fewer examples of that yet, but that's obviously a fear, and that's driven some of these policies of this administration.
Yeah, and on China, I do think they are the lead in electric vehicles, and that is pretty clear by the numbers. And not only are they producing it, the products themselves, like I mentioned earlier, they're very impressive, and they're innovative too. And the United States policymaking is in the spotlight, but there's also the EU itself is also looking at the EV vehicles coming from China, and they're thinking about I don't know if it's tariffing or quotas, but some sort of trade policy that will curtail even more EVs coming in from China. So it's, yes, the United States is really kind of this in the spotlight, but there are other countries, continents that are also thinking about this as well.
Yeah, no, it's an important question of where manufacturing occurs, and every country has their own version of national champions. And I think Germany realizes that if electrification continues at the pace it's at, Daimler and BMW, Volkswagen are not yet at that same caliber as BYD or the Chinese companies, and you could risk them missing an entire generation of innovation.
Yeah. Yeah, that's really interesting. All right, let's get into the final and fun questions. So while we were still working together, you traveled to the Galapagos Islands, which is an archipelago in Ecuador, famous for Darwin. I really want to go. Yep. What were some of the highlights of that trip?
So a couple of things. I absolutely loved it. I mean, I definitely encourage reading, particularly some of Darwin's journals on that trip. I mean, you really get to appreciate people who are traveling halfway around the world in sort of very primitive conditions, and to do that sort of scientific study and sort of understand what a unique ecosphere that was, that you got to see so many variations of species in such a short distance and everything else. And the adaptations of the tortoises, which some that were, all the different types and little microclimates they were all adapted to was fascinating. I loved it. A little bit hard to get to, but definitely worthwhile, and an appreciation for how fragile the environment can be. It also struck me how a lot of the Pacific Islands are struggling for fresh water. Desalinization is a very energy expensive and not a great quality product for a couple reasons. And so, those islands are very fragile from a biosphere and water cycle perspective.
Was there an animal that you really wowed you that you saw there?
Actually, the tortoises impressed me. The size and scope, and just sort of thinking of how long they lived. Some of them were there and probably knew Charles Darwin as a tiny shell or whatever. But we're so used to human lifespan, and sort of meeting another species of other things that have a different lifespan is humbling in a lot of ways, because I won't be here in 100 years more, and some of them certainly were. And then obviously the underwater part of it is amazing.
Nice. Yeah. Snorkeling. Okay. Yeah. I had a chance to snorkel in Thailand, and that was an amazing experience too, just seeing all the fish kind of float. And I guess for me, the most interesting part was how close they got to me.
Yes. No. And I encourage people to do snorkeling or scuba, do something to sort of get you the appreciation of the 70% of the Earth's surface that we don't normally get to see under.
Yeah, perspective.
Yes.
Yeah, so this is where I'm going to talk about my perspective as well. But do you have any book recommendations about maybe something you've read in the past or recently read?
Oh, gosh. So we did talk about the Idea Factory for Bell Labs. That was a great book. I also would, most recent things I've been reading. I've been reading a bit on, I read a lot about Singapore because I just went there recently, the history of the country. Lee Kuan Yew, the founder, really had an innovative approach, and sort of talking about differences of philosophy. Just the idea of having excellence in government and meritocracy in a way that we don't really see in the U.S. at all is fascinating.
Do you have a book name for that?
I'll get that. I can probably get that, but it was a 1,200-page book, and it was a 24-hour flight. So it was. I did a good bit of damage before we took off, but I finished it by the time we landed.
Oh, nice. Yeah. I guess I wanted to throw my book recommendations. Unfortunately, they're very U.S. centric. But this is related to a book that's very popular in conversations today. Abundance. A lot of people are talking about it. Ezra Klein and Derek Thompson. There's another book by Yoni Applebaum. It's called Stuck. And it's housing is in the United States. There's an issue where the housing supply is relatively low. That means housing supply is low. Houses are expensive. People have a hard time purchasing houses. what he more focused on was how people traversed throughout the U.S. over the years. So in the United States in the 1800s, there was the Western expansion. Lots of issues for many reasons with it, but overall, the European settlers that came here, they had lots of land and everything like that. So you would go from the East Coast to the West Coast, somewhere fertile like Washington, and you would set up a farm, or you'd have cattle that graze or something like that. And even in the early 20th century, you'd have a lot of people that move within the United States, and maybe not as far from the East Coast to the West Coast, but rural areas to more urban areas as opportunities came there. Mm-hmm. And what he focuses on is how I'm only about a quarter of the way through, but he focuses on how over the past few decades, we've kind of been more stagnant as a country. And as somebody that has lived in three different places within the U.S. across the East and West Coast over the past 2 years, it's a very interesting book. And I think that as people in the U.S. taking advantage of moving around is very, very, very valuable. And I've lived in Philadelphia, millions of people there. I've lived in towns with 100,000 people. I've lived in a town that was as small as 10,000 people, and just so many different perspectives, meeting so many different people, how even businesses function. Mm-hmm. There's a lot of value in that.
Absolutely. And that's a global phenomenon too, I would say. I think it's, I think it's one of the challenges the EU has, that it's harder to move a mechanic from France to Poland or vice versa. But yeah, having that ability of a labor force and a population that moves, definitely helpful from an economic perspective.
Yeah. So I kind of am turning this into a soapbox for so that's one argument on perspective. Another argument, last book recommendation I'll give, again, very US centric. But this goes back to, I think perspective is very, very valuable. This is more perspective from one person, probably going to come out of left field, but the autobiography of Malcolm X. Very interesting book. It's seeing that perspective, different time period, like very, very different life experience from somebody that was Black in the early 20th century, father murdered, mother was eventually driven into a asylum because of the local government, and kind of the way that he grew up over time. And again, somebody that's white, but very different than somebody that's Black, especially during that time, and trials, tribulations, understanding the anger, and then also kind of seeing him evolve as a person and Malcolm X, he eventually became Muslim and he went over to Mecca. Mecca's a holy site for anybody that's Muslim. And he got to congregate with different people, different skin colors. And that gave him a different perspective on everything. But divisive figure, again, out of left field, but just wanted to put that one out there. I think it's especially if you're from the US, highly recommend that book.
Excellent.
All right. Done with my soapbox. What are your go-to news sources nowadays?
Yeah, that's also a generational divide question. I mean, I unfortunately am the product of my era I grew up in. I'm still a legacy news. New York Times, Wall Street Journal are still valuable go-to sources for me. I would say I generally am very skeptical of social media. I'm still horrified how much is on Twitter, X, or whatever as a leading source. The degree of manipulation or misinformation there makes it a very fraught with risk place to go for information. It's a hard thing of a lot of data being available, but not all data being useful.
Yeah. There's a lot of information. There's overlap in where we get our news. Wall Street Journal, that's definitely. I also really, really enjoyed The Economist. I think their coverage and the depth that they can go to, back to perspective, you'll learn things about different countries and continents They do a very good job in telling you what's going on in Africa, what's going on in South America, what's going on in Asia. And I also, it's good to sometimes read foreign news, like the South China Morning Post. I believe that's out of Hong Kong, and it's a really good news source. Different perspective, different information, different ways of looking at things, and there's a lot of value in that.
Yeah, I absolutely echo with that. Straight Times, the Singapore version. It's very important to get those perspectives.
Yeah. All right. Matthew Taylor, thank you so much for coming on.
Thank you for coming back, and thank you for having me here.
All right. Thank you. Thanks, everybody.
Last night I had the strangest dream. I sailed away to China in a little rowboat to find you, and you said you had to get your laundry clean. Didn't want no one to hold you. What does that mean? And you said, ain't nothing gonna break my stride. Nobody gonna slow me down. Oh no, I got to keep on moving. Ain't nothing gonna break my stride. I'm running and I won't touch ground. Oh no, I've got to keep on moving. You're on a roll and now you pray it lasts. The road behind was rocky, but now you're feeling cocky. You look at me and you see your past. Is that the reason why you're running so fast? And she said, ain't nothing gonna break my stride. Nobody gonna slow me down. Oh no, I got to keep on moving. Ain't nothing gonna break my stride. I'm running and I won't touch ground. Oh no, I got to keep on moving. Never let another girl like you work me over. Never let another girl like you drag me under. If I meet another girl like you, I will tell her. Never want another girl like you.